Hey guys, Dave Keller here with Market Misbehavior. Today we're going to talk about the QQQ, the Nasdaq 100. What's next for this key growth-oriented benchmark here in the United States? The QQQ has been on an incredible run. Of course, this week we had NVIDIA, just blowing away earnings. All sky-high expectations were eclipsed. NVIDIA up double digits earlier in the course of the week, moving to new all-time highs and beyond. The QQQ making a new 52-week high again this week. So what's next? This is a particular type of video we like to do called a Choose Your Own Adventure style video. We'll lay out 4 potential scenarios for a particular ETF or stock. In this case, we're looking at the QQQ. I would encourage you to think about which of those 4 scenarios you think is most likely and why. Drop a comment below. Tell me which one you vote on and what justifies that outcome in your head. Now, before we get there, we're actually look at the last time we did this Choose Your Own Adventure style video, which was back in November. You'll see which of the scenarios almost perfectly ended up lining up with what the markets did in the 6 to 8 weeks afterwards. So today, it's all about what's next for the QQQ. Before we get to the charts, here's one more thing I wanted to tell you about. I'm a technical analyst, which means I spend hours every day looking at hundreds, if not thousands of charts. But in my own decision-making process, it's not purely technical. I actually spend a decent amount of time looking at fundamental factors that are actually driving companies and empowering them to grow for multiple years going forward. I look at macroeconomic data like the Fed and inflation and interest rates to think about how all those factors might impact those stocks and ETFs that I'm looking at. And I also have learned from spending years working with institutional investors that having a good quantitative model is super important. What a quantitative model does is basically look at the characteristics of successful stocks, looks at all the factors, technical, fundamental, everything, and wraps it into one rating, and then allows you to focus on the best opportunities within a particular set of stocks or ETFs. The good news is, as an individual investor in 2024, you have access to a pretty decent quantitative model through Seeking Alpha. If you go to marketmisbehavior.com/seeking-alpha, you'll be able to take advantage of their quantitative rating. They actually have a pretty sophisticated quant model that is driving their quant rating. You can then cross-reference what we're talking about on this video, is looking at the charts of leading stocks, looking for big base breakouts and good technical opportunities, but also look to see if the quantitative model from Seeking Alpha supports the upside potential of those names. So go to marketmisbehavior.com/seeking-alpha to find more information. Usually get a better deal for you. It's an affiliate link, which means it helps me make Market Misbehavior awesome, and we're all happy. So check it out, and let's get back to the charts here. All right, so here's my chart of the QQQ, and this is going back 2 years, and I wanted to show you because the last time we did this was in November, and it was right after the Qs were coming out of what's called a bull flag pattern. Now, if you don't know a bull flag pattern, it's basically where you have a big run higher, and you actually call this the flagpole. You have a parallel decline, sort of a trend channel, a downtrend channel with parallel highs and lows that move counter trends. They move against the larger trend, or what we call the primary trend. Look at how the bear flag actually lined up almost perfectly with the first Fibonacci support levels. Take the December 22 low, the July 23 high, you go about 38.2% of the way down, and that's this level here right around 340. You can see we bounced off of there and then broke out of that bull flag. So at the time we did the last video, it was here in mid-November, we'd broken out of the bull flag, and I would argue that really sets up a pretty bullish trajectory for stocks. Of course, since then, the 3 months since we did that last video have been pretty staggeringly strong, right? The QQQ, a lot of leading growth stocks like the Magnificent Seven have had a clear pattern of higher highs and higher lows, and that's been echoed even through this week as we made another higher low, and now once again threatening an all-time high with the QQQ around 440, just below that, going into the end of the week. The momentum overall has been pretty strong, and of course the Qs have outperformed the S&P 500, as you can see in the bottom data series. Now, back in November, and I have a link in the description below if you want to watch that video and see how we describe those 4 scenarios and what the bullish scenario kind of looked like. But look at which one actually played out almost perfectly. It was scenario number 1, the super bullish scenario. So I tend to think of these in 4 different sort of scenarios, right? You have the very bullish scenario where things just continue to show strength. You have the mildly bullish scenario where things are not as strong but pretty strong. You have the mildly bearish scenario where we start to pull back, and then you have the super bearish scenario where things really start to get ugly. And again, the point of this exercise is what's called probabilistic analysis. This is to force you outside of your preconceived biases. A lot of times we just sort of default to a bullish or bearish outlook based on our positions, based on the echo chamber of social media, based on people we talk to and things we read and listen to. But at the end of the day, what institutional investors do is really think more in terms of probabilities. What's the most likely outcome for the markets in the outlook period that I'm thinking about? But what are some alternate scenarios? Often want to think about different scenarios that are alternative to what you think is the most likely scenario, because what that means is then you're stretching your thinking a little bit. You're thinking about what might happen, right? What if the market is quite strong or it's quite weak? What does that do to my portfolio? How would I manage risk or identify opportunities if each of those 4 scenarios plays out? So when we did the video in November, the super bullish scenario number 1, almost perfectly matched the action in the QQQ in the 6 to 8 weeks after that. And since then, it's basically followed that same trajectory. If you look at the slope of that arrow that I drew back there in November, it's pretty much just continued unabated. That brings us to our current choose your own adventure style discussion. Here are the 4 different scenarios. So again, I'd encourage you to think about these 4 scenarios. Think about what would actually create that scenario, right? What would happen for the markets to continue in that particular trajectory? What would that do to your portfolio? How would you manage risk or identify opportunities? Don't forget to drop a comment below. Let me know which of those 4 scenarios you vote on and why you think that's the most likely scenario. Really fun to come back later when the market actually plays out, see what you thought was most likely, see what actually happened, and maybe that stretches your thinking for the next time. So first we have the very bullish scenario. And what I did here was basically just extend the bullish scenario, scenario number 1 from the last exercise, and assuming a consistent trajectory. The reality is here in late February of 2024, and looking out about 6 weeks, that takes us to about mid-April, early mid-April. So if you think about it, the markets have actually been in an incredibly bullish structure, right? The Nvidias and Metas and others have shown so much strength. And after we gapped higher on the CPI report here in November, it's been a pretty consistent, what we call a Dow theory uptrend of higher highs and higher lows. And as long as that pattern continues, the trend is in very good shape. So the very bullish scenario basically assumes that pattern of higher highs and higher lows continues. It assumes that the pace of this market advance continues in a similar fashion. It assumes that the leading growth stocks like Nvidia and Meta and others don't take much of a break, but actually this week's report from Nvidia just is fuel for this fire that just propels the AI frenzy further and further to the upside. So this is what I would consider probably the most bullish scenario that I could think through. That would take us up about another 7 to 10% in the next 6 to 8 weeks, depending on exactly how we draw that angle. But it would take us up quite a bit, really threatening up toward that 500 level for the QQQ. If you think about it, this one important thing to remember is the next Fed meeting is here in mid-March. So what we would probably have to see for scenario 1 to play out is that the Fed sort of makes comments suggesting that they'll probably start to be lowering rates here at some point. And again, we'll see if rate cuts actually happen in March. It seems unlikely based on the most recent language, but it's certainly possible. I would say scenario 1 probably involves a rate cut either happening at the March meeting, or they certainly talk about an imminent rate cut maybe at the next meeting, which would be at the end of April, beginning of May. Scenario number 2 is what I call the mildly bullish scenario. This is where the market still drifts higher, but the pace slows down a little bit. I would say scenario 2 probably involves those leading growth names like Nvidia and Meta taking a break. They really couldn't decline too much because if an Nvidia, which is up so much year to date and just in the last 12 months, if it pulls back a lot, those companies, those stocks are so big and such a big impact on our major benchmarks like the QQQ that if Nvidia and Meta and Amazon and Apple all start coming down, it's really going to drag the benchmarks down quite a lot. And I think that would be how scenario 3 and 4 probably come to fruition. So scenario 2 would probably be that those major leading growth stocks don't really correct a whole lot, but they maybe stall out a little bit, right? They sort of chop around. If you look at the charts of like Amazon and Apple, they're really not going up at the moment. They're kind of sideways, right? They're sort of consolidating. So that consolidation would probably need to continue. Scenario 2 would probably involve other areas of the market like industrials. Think about like airlines and shipping, trucking companies. Heavy construction names would probably do much better. Maybe materials, maybe energy, those sorts of financials, right? Areas of the market that are not particularly thought of as growth leadership stocks, but also have a potential to move higher. Maybe they start to come up, and even though the growth leadership takes a pause, those other names start to work, and it's just enough for the major benchmarks to drift a little higher. So none of those are really heavily weighted in the QQQ, which is why I would say that, scenario 2 means that those leading stocks probably stop going up aggressively, but they don't really go down. They sort of hold, maybe tread water for a little bit. Now, scenario 3 and 4, which are the more bearish scenarios, I would argue probably is where the seasonality comes to fruition. If you know market seasonality, and I'll put a link below to some discussion about the seasonal trends that are often at work in an election year. What happens in an election year like 2024 is you usually have strength in January, February, particularly into March, usually is one of the weaker parts of the year. October is probably the weakest, but second to that would be March. And often the market has a big low in March, similar to what we saw actually in 2023. So scenario 3 and 4, those bearish scenarios, basically means that the market follows the traditional seasonal pattern. Scenarios 1 and 2, the bullish scenarios, basically be the market ignores that seasonal pattern, and 2024 is kind of an aberration, right? It's sort of an unusual election year. 3 and 4 are more of the usual election year kind of behavior. So scenario 3, which I call mildly bearish, means we stop going higher. Probably those leading names like Nvidia and Meta, don't stop going up and probably really start to pull back a little bit. But it isn't that painful of a pullback. You have to remember that stocks can correct in one of two ways. They can correct in time, they can correct in price, or they certainly could correct in both. Scenario 3 is probably more of a time correction, maybe a brief price correction where it comes down a little bit, but it's more about sort of holding our ground. So I would say scenario 3, that mildly bearish scenario, means we don't get much higher than we were at the end of this week, around 436. But we stay above that 38.2% retracement. The way I got that was taking the low in October, the high here this week, just assuming that the high is right about current levels. 38.2% of the way down is right around 403, 402, 403, so just above that big round number of 400. So I would say scenario 3 means we don't go much higher, we pull back. So it is a normal pullback, which is pretty common in an election year in February and March. But it's not that painful, right? It sort of sets us up for a nice rally in April, May, and maybe beyond. That brings us to the super bearish scenario, scenario number 4. It's always important, I would say, regardless of where you're at on any particular chart. Think of a super bullish and a super bearish scenario, and then start to fill in the stuff in the middle. Because by thinking about the extremes, you can really think about what's the severe scenario. Like, when are things super unusual, like those 3, 4, 5 standard deviation moves, just so you make sure you're including all the thoughts, all the ideas in your thinking process. So I would say scenario number 4 is where the seasonality that is common in an election year really hits home, right? And the market pulls back. We have a major low maybe in March, and maybe the bottom actually happens here. And by April, we're pulling up a little bit. This is the general direction of the trend, meaning we don't go much higher, and we really start to sell off. And March is one of the worst months in recent history. Scenario 4, I would say, probably takes us down to the 61.8% retracement, which is right around 380 on the QQQ. That's about a 13% drop from where we ended the week last week. So if you look back at market history, a 5 to 10, maybe 15% drop isn't that unusual. And even in a constructive market, right, even in a primary bull market, you get pullbacks in the 10 to 15% range occasionally, and that's acceptable, right? That's actually a pretty normal occurrence in this sort of environment. But scenario 4, because we're going through that first or that second Fed meeting of 2024, probably means the Fed meeting is a lot less optimistic. Maybe it's a much more hawkish tone, suggesting or implying that rates are going to remain elevated for an extended period of time. Maybe inflation data, which we'll get a little bit more of before that next, over the next 6 to 8 weeks. Maybe the inflation data starts to turn higher, and you get signs of economic overheating again, which would mean that the Fed can certainly not lower rates anytime soon. Maybe the first rate cuts are pushed way down the calendar later in 2024. The market takes that as a really negative sign, because rates remaining elevated means consumers are probably not going to spend as much. I would say scenario 4 probably involves names like Nvidia and Meta. Really, at this point, you'll look back and think of it as a huge blow-off rally when they give back a lot of their recent gains. And again, I don't think any of these scenarios over the next 6 to 8 weeks are end-of-the-world scenarios, but scenario number 4 is a very different feel. This would be a dramatic feel, and even though we might only get down about 10 to 15%, people will be talking about a retest of the October low, and maybe even further retests, getting down into the COVID range on some of the major benchmarks like the S&P and the Nasdaq 100. So there you go. Those are your 4 scenarios. Scenario number 1, the very bullish scenario, means the S&P and the QQQ in this case continue their trajectory. Higher highs, higher lows, consistent pattern. The mega cap growth names continue to work. all is well in equity land. Scenario number 2, what I call the mildly bullish scenario. Things maybe stop going up aggressively. The growth names maybe take a bit of a pause, but it's still not that bad. It's probably more of a pause button as opposed to a real negative move for stocks. Scenario 3, the mildly bearish scenario, means we're really done going higher. We correct a lot more in time than in price. This is more of a, a brief pullback, but it's not that bad, right? And some of those leading names that have done quite well can pull back quite a bit and actually still be quite constructive and probably sets us up for a really good entry point in March and April. Scenario 4 is the super bearish scenario. That's where things really start to get ugly. That would be quite a change of character. That would mean breadth conditions get a lot worse. That means the Fed probably ends up being a lot more hawkish, suggesting that there's a lot of economic strength that was unexpected. Inflation is still well above their bogey, and they need to start, keeping rates higher for much longer. That puts enough pressure on growth stocks to drag the QQQ down. Drop a comment below. Let me know which of those 4 scenarios you see as most likely and why. For Market Misbehavior, I'm Dave Keller. Have a great one. We'll talk to you again soon.